Hey team, Ben from Pivot, and today bringing you money news in human words, helping you understand the top news stories that impact your money, what you need to know, and helping you cut through the noise essentially and making sense of what's what. So my first piece from this week is around the economy not being quite as strong as we've been led to believe over the last little while. A bunch of economic data has come out and essentially shows that the growth in Australia is sitting at 0.8% for the last quarter, which brings it to 3.3% for the year, which compares to what was forecast in the May budget by Jim Chalmers of 1.8% for this current quarter. So this is important because obviously the economic growth dictates what happens, like how much the economy is going to slow when interest rates are going up, or when any other sort of headwinds are at play here. And essentially, a lot of the growth has been in bigger chunks earlier on in the year, which is now phasing out. So the quarters are running at like 2-3%. Now we're at 0.8%. And as the next quarters, if they stay along the same level, it's going to significantly reduce that the overall growth rate of the economy, or reflect a significantly lower overall growth rate of the economy. But it actually gets worse because the household spending is up, but when you dig into the data, it shows that actually the spending that households did was from their savings. It was their real disposable income of households has actually gone down by 0.9%. And the spending has gone up, which means that essentially households are dipping into their savings. And another big driver of those economic, the growth that we've seen has been businesses increasing their inventories, because that level was right up, which is mainly from companies, because they've been suffering through these supply shortages. They've been replenishing their inventories to get sort of ahead of what they can. So what that all means is that the economy is probably in a little bit of a weaker position than definitely was forecast, but then we would like it to be, and creates a little bit of a risk with what's going on inflation, interest rates at the moment as well. So absolutely one to watch. I think the data over the next 3 months is going to be actually critical to see what happens from the RBA side. That flows through to what happens in the share market, property market, jobs market, all of those things. So I know that the numbers can seem a bit boring, but yeah, it's actually pretty critical to whatever happens for investors and people more broadly with their money, and one to watch over the next little while. My next piece is on the Biden backflip around oil prices, and in particular, not so much oil prices, but the oil supply. And it's got Biden going to visit Saudi Arabia, which is going down this week, to try and shore up some oil supply contracts, essentially. That oil supply has been disrupted massively off the back of the Russia-Ukraine conflict. Bans on Russian oil, and logistics around that as well. The Biden administration have been really critical of Saudi Arabia because of basically an assassination of a Saudi dissident in, I think it was 2019 or 2018. And Biden came out with this really hard line saying that he wasn't going to have anything to do with Saudis, and they're essentially cut off. Now he's backflipping, and it sort of highlights how important he thinks it is to stabilize oil. Probably partly comes from the fact that the US has been releasing oil from its strategic reserves over the last little while. They saw the oil price go up, so they've got this huge stockpile of oil in country, and they've been releasing that into the market to keep the prices lower. But the thing is that they do have a target on where that strategic reserve needs to be, and the release of oil that Biden has spoken about actually has the oil levels going lower than what their target is. And that means that they're going to have to actually replace the oil that was in there, which is going to actually further add to the supply, because not only do people around the world need to consume the oil that they need to consume, but we've got the US needing to actually replenish its strategic reserve. So I think could have a significant upward impact on oil prices when that starts to happen. But yeah, it highlights the fact that this is a super serious issue when it comes to global markets. And the oil price, again, it seems like a small thing, but it impacts almost all companies because of transportation costs, people's cost of living, cost of production for any sort of consumable goods, and all of those sorts of things. So yeah, an interesting one to watch. And one obviously that also is impacting us at the Bowser, and I'm fingers crossed that we can find some sort of reprieve to get that price coming back down. Another thing that I thought was interesting over the last week is around I saw this article with the title Labor is looking to clean up the hot mess of regulation in financial advice with the AFR. Great piece. And obviously, as an advisor, it's a little close to my heart. But the financial advice legislation has become super complex. Now, the reason this all probably seems like a money nerd thing and something that you don't need to worry about, but the good news is for just everyday Aussies is that by potentially reducing some of this regulation, it could actually reduce some of the costs of financial advice, making financial advice accessible to more people. Also means that when you get financial advice, it's going to be simpler for you so you can actually understand what you're getting. And not just be bombarded with these massive documents that are difficult to interpret. So I'll be keeping you guys abreast of what's going on there, but I think one to watch over the next little while. I was reading last week about this build to rental boom that's coming. Basically, this huge tower has just come online in Melbourne. Southbank Home is the company that they've got this location where it's a large apartment tower that was built specifically to rent, helping to sort of combat that rental property shortfall. Also, hopefully, having an impact on rental prices because we've seen a huge increase for rents over the last little bit. So, giving renters more dedicated accommodation. Also, from an actual lifestyle perspective, that these places have really good amenities because they're specifically built for the purposes of living. It's almost like a co-working and they're having co-living spaces as well. Not quite to that extent, but more purpose-built with dining areas and breakout spaces, big office areas that are conducive to work from home, COVID bunker living. So I think that this one is important because it actually shows that one, there should be some impact on rental prices over the next little while. Two, for property investors and people looking to invest into property, probably highlights the fact that you want to make sure that when you do have an investment property, that the property that you buy, if you're intending to rent it out, that it's going to be appealing to compete with these specifically purpose-built build to rent properties. So it also has an impact, I think, on the value of non-build to rent properties, potentially making them more attractive more attractive and higher values in some circumstances, maybe lower in others. But if you've got a premium property that is not necessarily just a build to rent, it might attract a premium price because of the dynamics, and also because the buildings are not as big, as these massive purpose-built rental apartment buildings. So I think as an investor, be really aware of this and careful when you are choosing a property as an investment. Big decisions are not something that you want to get wrong. So you want to make sure that you're making the right moves based on what's happening in the changing market that we're seeing as well. One other piece which is around wages in Australia at the moment, we've seen that the Labor government has made a submission to the industrial umpire about raising the minimum wage in line with the massive inflation that we've seen over the last little bit. That impacts 2.3 million Australians that are on the minimum wage. Almost 2/3 of these workers are women. So potentially there's inflation's at 5.1%. That's significantly higher than what a typical minimum wage increase might look like. So potentially some relief there for people, which comes at a good time with, the cost of living being so high and increasing inflation, petrol prices and all the rest of it as well. It's pretty unprecedented for the government to make that sort of suggestions, because the governments typically stay out of those industrial type calculations and decisions. And it is something that, while no doubt it will be massively helpful for people on minimum wage, the flow-on effects through the economy potentially has a further upward impact on inflation, or to say it a different way, that it's certainly not going to slow inflation the way it would have, is that if people have less, they are sort of forced to spend less, whereas if people have more, they can choose to spend more. So the impact on inflation is likely to be positive, which in the high inflation environment probably means that it's another reason that interest rates are going to increase a little bit more than what they would in the absence of that. So welcome news for people on minimum wage. Interesting to see the flow through to the economy, and also whether the industrial empire actually listens to Labor's decision or Labor's suggestion and puts those things into place. The next piece is around the cost of the New South Wales Southeast Queensland floods, which is now being put at $4.3 billion. This one is important because I think for all people with insurance, it has a massive impact on insurance companies, and also creates a fair bit of risk in the markets, because this $4.3 billion is essentially coming from either their bottom line or the pockets of Australians. And in both cases, that flows through to, in the case of the companies, it's going to impact share market values, share prices. If in the case of individuals, it flows through the economy, and what it means, in those pockets of the economy as well, with people being impacted. So, it also is likely to flow through to people's ability to get insurance, and therefore into the property market, definitely around the northern New South Wales, southeast Queensland areas, but also potentially into other markets as well, as the prevalence of natural disasters and these severe weather events just seems to be increasing. And look, increasing insurance costs. I feel like everything that I'm talking about, it's just more and more costs are increasing over time, and tying in with this inflation issue that we're seeing at the moment. Another piece that I saw around construction costs, that we've seen a huge uplift in construction costs, and a bunch of people that contracted into construction agreements with these development construction companies that are now being asked to pay more for works that they had already agreed on fixed prices for. One example that was given in this piece that I was reading, where the people that were looking to do a knockdown rebuild were asked to pay an additional $100,000 in costs for the same price that their property build that they've contracted to do not only 12 months earlier. And the reason for that is because we've seen a huge uptick in costs to construction companies. So we've seen, I think, 40% increase in the cost of materials, around 40% increase in the cost of trades. And it means that the construction companies are now struggling to deliver the jobs that they'd spoken about at the levels that they previously committed to. Interestingly, like the courts have got involved, and in Queensland, it's been shown that the construction companies have been told that they're unable to legally enforce any changes to contracts because they do have valid contracts in place. But what that means is that for the homeowners, if the construction companies can't deliver the jobs without losing money, it could be, one, it could lead to the construction companies going bust. Second, it could lead to the jobs taking forever. And third, it flows through to the construction market in other jobs that are outside of this particular market. So I think there's a fair bit of risk there. We've also seen in another piece we saw Solido Builders in Queensland join the long list of construction companies biting the dust at the moment. All of these people get caught on the hook. And I suppose for people that are looking to do builds or significant renovations over the next little while, it's important that you understand the company that you're working with. Obviously you want to get your jobs done for whatever you've contracted to do, but what does that mean for the companies, for the jobs, and for your ability to actually get your job completed in the end? So I think would be interesting to see what that means. I know that new contracts coming through now have all of this stuff priced in, but for the people, it's like a 2-year pipeline of these jobs. So could take some time to filter through and for us to see the ramifications. So guys, that's my best of the week for this week. I hope you enjoyed that. And any questions, feel free to pop them in, or things you'd like me to cover in the upcoming sessions. Otherwise, I'll catch